So first rates, just a second, just come up on your screen and I'll let the clock do all the talking. You would definitely be watching out for some of the consumer tech names. You would be watching out for Paytm, where there's an official denial which has come now. Adani group of stocks, will they continue to build on? Names like Zomato, are they likely to scale up further? Not too many stocks in news. We will start with the Bank Nifty, the Sensex, and the market breadth. The market breadth is good. The Bank Nifty is just flat with a downward bias. The auto dispatch numbers all of them have come in, and the surprise there is Ashok Leyland, if you ask me. iShares CV business, which is small business for them, so the rub-off effect may not be there, but Ashok Leyland, I think numbers were decent. RVNL, I think, is the newsmaker. They have got nomination. It's really the order news which I think is helping RVNL there, up by about 8%. You got Adani Enterprises down 9%. These are crazy moves for Adani group of stocks. 10% down, 10% up, 10% down, 10% lower. Just so much happening there that it's dangerous now even to talk about them. Vedanta, 1% higher. You've got Adani Power, which is 5% higher. And you've got no price change in Zomato. And you've got a little bit of price uptick, which is there in Yes Bank now. But the real star today, I think, is RVNL.
Oh, well, yes, RVNL is up around 8% on account of that news. Let's pull up BHEL as well if that one is reacting, because it's a similar news flow. That's the L2 bidder. So, yeah, it's just a sentimental uptick on that one. KNR Construction also back in order, so that one is flying higher. Olectra Green Tech has been on a tear since that green hydrogen bus announcement was made, and yesterday as well there was a positive news flow. So, that's trending high. You also have Suntech Realty reacting positively to that latest deal that they have signed as well. On the losing side, as we pointed out, it's Adani Enterprises that really deserve mention. 10% cash down coming in on that one. ACCA, Adani Ports are the other top losers. Sectorally speaking, it's autos, which is actually doing quite okay. Bharat Forge, on account of that order win, is also high by around 1%. Hero MotoCorp is reacting to a good set of numbers. So overall, a decent start coming into the Indian markets, and even if you look at the advance decline ratio, it's firmly in favor of advances, so that market breadth continues to improve, and it's the Nifty Bank which is managing to hold into the green, while the Nifty has just marginally slipped into the red. Let's get the first trades going then as well. Kunal, what's the trade that you are executing or spotting at this point of time?
So that's IEX, a stock which I think has done reasonably well over the last couple of days, trading at 146 approximately on the spot level. So that's a stock which I would look to buy.
All right, IEX, and that's what Kunal is looking at. Meantime, Naresh, let's get in your view as we're circling around the 17,430 mark and nothing happening with the broader markets either.
Yeah, so continues to remain flat, but on dips there's a buy. Mahindra Finance is what I continue to like. 252 to 255 is the zone which I continue to accumulate, expecting a bounce here in the near term.
Okay. Sanjeev Prasad joined just now. Let's connect with him. Sanjeev, good morning. Thank you for joining us. Singapore or Mumbai? In these days in Zoom, we can't figure out.
It's Mumbai as of now.
How was the Kotak conference, Sanjeev? I just heard some fantastic, things about how FIs are super excited about India. They want to be in India, but they are really finding that cheap or that value idea.
The conference was great. We had massive participation, something like 800 institutional investors, almost 200 companies. So yeah, it was very well attended. You're right. Investors are clearly excited about India, the medium-term, long-term story. But as of now, people are grappling with valuations. So, look at valuations for the broader market at almost 20 times 1 year forward, clearly not cheap. More important, if you look at the kind of names investor would like to own in India, mostly the consumption stories, investment names, all very expensive at this point in time. So that's the whole struggle. And you also don't have a lot of clarity on the whole macro situation, specifically global interest rates and domestic interest rates as to where they settle eventually. So yeah, so it's a I guess situation where investors would like to increase exposure to India, but are just grappling with short-term valuation as also macro issues.
When do you expect the tide could turn, and what will it take for the tide to turn?
It's just time, I think, to be honest with you. I suppose you still don't have clarity on peak interest rates. Every time, the market makes that assumption that we are near peak interest rates, the inflation numbers come out on the higher side, and then inflation and interest rate expectations move up once again. So if you look at US as an example, the peak interest rate expectation now gone to 5.5%. 9 months back, it was 3.5%. 1 month back, it was at 5%. So that's the struggle. Inflation is turning out to be a lot more entrenched. Core inflation is very, very sticky. If you look at India, early we thought 6.25 was the peak policy rate. It's already moved to 6.5. Now we see upside risk to 6.75 and even 7 now, given a lot of volatility on food prices linked to the somewhat, or at least as of now, shaky outlook on monsoon. So unless you get this clarity on the peak interest rates and combine that with very high valuations for most parts of the market, it's just a struggle for the market.
Sanjeev,
So 800. We could see earnings of rates in this kind of a market environment, which means hopefully the market just goes through a period of time correction. Valuations start looking better over time. Maybe that's when interest starts coming back.
So Sanjeev, 800 fund managers came to the conference. All of them are coming to India. They're liking India, but yet they're selling India. Last year, FI flows were negative. This year also FIs are negative. So I just fail to understand that you like India, you come to India, you spend time, you meet Indian companies. My friends tell me that all of the Indian corporates who come to these conferences, the demand to meet them is high, it's a house full. And yet every time they go back positive, but what they do is actually negative.
I guess just the constraint of valuation at this point in time. See, until recently, you also had this option of China, right? You had the China reopening trade. So a lot of foreigners were participating in that, simply given the valuations were too low in China, let's say 2-3 months back. But of late, even that trade has started to cool off a little bit post this whole balloon episode in the US. So again, geopolitical tensions have come to the forefront, which has dampened, the spirits of some of the investors who are looking at China more favorably. But at this point in time, it's not as if, they will look at India more favorably just because they're not looking at China that favorably. I mean, the valuations are the stumbling block over here. You just can't get away from high valuations. So as I said, we just need a period of time correction. Hopefully, we don't see a major price correction. And 6-9 months later, valuations start looking more reasonable. And, the medium-term story of India is absolutely great, So investors will probably start biting the bullet at somewhat lower valuations, I assume.
Hi, this is Anisha also joining in the conversation. I want to get your take regarding the IT sector because I was at the NASSCOM event yesterday, and while there was a lot of positivity about medium term, there were murmurs that near term there is a lot of delay in decision making and there is going to be a lag impact that will definitely come to India. Would you concur with that view?
Yeah, I guess so. See, the challenge as of now is the stock prices seem to be factoring in some sort of I would say a modest slowdown, not a big slowdown, or God forbid a recession in the US. If you look at the commentary from the IT companies, it's mostly about shallow sort of slowdown, somewhat muted demand environment, but nothing very alarming at this point in time. So most companies are still of the view that they will get to mid-single digit to as much as almost double-digit kind of revenue growth in the next financial year. So far, not that bad, I would say, the demand outlook. But the challenge is the US economy still continues to be very, very strong. Labor markets are very strong. So the challenge for the US Fed is, it has to probably keep raising rates for some more time. We may be getting to the end of the interest rate cycle, but I suppose we'll have to take it up to 5.5. That's what the market is assuming anyway. And probably keep it at those levels for a longish period of time, just to pull off the labor market, which is still very, very robust as of now. And, as I was saying earlier, every time we assume we are at the end of the interest rate cycle, things are priced on the negative side. So the question is, how much slowdown needs to take place in the US for inflation to break? That's where I guess the debate is. And ultimately, if it boils down to a situation where the economy has to slow down significantly for inflation to come down, then we have a problem in that case. Because if you look at the multiples of the IT company, they're definitely not pricing in a big slowdown in the US. Most of them are trading at above pre-COVID levels, and they're pricing a reasonably benign demand environment for now.
Sanjeev, hi there, morning. Wanted to get in your outlook on earnings because yes, we did see some earnings downgrades in the previous quarter, but the general sense is that as we're seeing raw material price, fuel costs, etc., easing, that perhaps the next quarter could be quite promising. What are you penciling in?
We are looking at about 15% growth in the net profits in Nifty index for FY24, about 16% for FY25. Yeah, so as of now, it's looking okay. But keep in mind the fact that discretionary demand has not been looking that great for the last quarter or so. So you could possibly see some downgrades in the auto and some of the other discretionary sectors. But other than that, I think we are okay on the earnings part. If US goes through a bigger slowdown, then maybe you could see some earning downgrades in the IT sector also. But other than that, we are quite comfortable with our earning numbers because it's not as if we built in very strong earning numbers anyways. If you look at for the banking sector, for example, we have only built in 5% growth in the net profits of the banking sector, that is in the Nifty 50, assuming compression and NIMs. So we have tried to be careful in terms of factoring in some of the risks which we are seeing across sectors in terms of slowdown in discretionary space, let's say weaker NIMs in the case of banks, etc. But let's see, the wild card is clearly the state of the global economy linked to interest rates.
Expect a 5% growth in banking, because if you're assuming that earnings will grow at 15% and banks will grow at 5%, shouldn't it be other way around? Because banks are always a multiplier to the economic growth.
No, this is just an aberration that in FY23 is an abnormally strong year because you had a perfect combination of strong credit growth, massive expansion NIMs linked to the lag effect of increase in lending rates and increase in deposit costs, and very low provisions. Going forward, I would assume you would see some compression in NIMs as borrowing or deposit costs catch up with your lending rates. And I would assume banks would start making some provisions just to be on the safer side. It's not as if we are expecting any issues as far as credit quality is concerned, but probably provisions may just go up. Banks may create some extra buffers going forward. So that's what we assume for the time being. It's possible you're right. You could see some positive surprise on the earning numbers of the bank, especially if interest rates turn out to be on the higher side for longer. In that case, the NIM compression that you're building in from, let's say, the first quarter of the next financial year, that may get extended by another quarter or so.
So as you look at the construct of the market, Sanjeev, where do you think markets are still very optimistic about the earnings growth? They are in a denial mode. So we could be in for disappointment as the year unfolds. And where do you think markets have already turned very cautious and very bearish, and if at all the turn of the earnings would be on the upside?
So autos for sure on the first one, where markets have been too bullish for long. Numbers are simply not coming through. Even if you look at the February numbers for the auto company, volumes are very, very disappointing. Look at the 3-year CAGR, volume growth for most of the segments. Two-wheelers is even negative. So there's always this expectation that things would turn around. But, I don't know how long the market can keep making that assumption. If you look at Maruti, same thing, there was a big expectation around recovery in SUV volumes, still not the case. And multiples are actually on the higher side. So I think you could have a situation where you could not only see earning downgrades, but also, cut in multiples if the earning numbers don't come through. So that is one area where I think the market is looking like it's too optimistic. IT maybe to some extent, because this is an evolving situation, right? People are just taking cues from whatever they are seeing currently and whatever guidance they're getting from the company. They seems to be still suggesting a reasonably benign demand environment. Some slowdown, but not a big slowdown / recession in in the US. Yep. So yeah, so there could be some downgrades over there too. Although having said that, IT companies do have some buffer because this year at least, the increase in employee cost would be a lot more muted. So also given the depreciation of rupee, they have some buffer for sure. So maybe that, cushions the negative impact of, let's say, a weaker than expected top line growth. That, yeah, banks possible. You could see some upside over there. Other than that, I think we are okay. I don't see, scope for major earnings upgrades for sure in most of the sectors, I would say. Downgrades, maybe some of the other consumer discretionary names, assuming the recovery is, let's say not even two, maybe 3-4 quarters down the line, you could possibly see some earning downgrades over there.
All right, Sanjeev, appreciate your time. Thanks so much for joining in with your take.
My pleasure. Thank you.
On the markets. All right. Where we at? 17,400. So absolutely status quo on the index right now. And individual movers, Adani Enterprises is under pressure, M&M, TCS, Tech Mahindra, Axis Bank, Bajaj Finserv. It's literally a handful of stocks that are managing to buck the general trend. L&T, Hero MotoCorp, as well as Tata Steel. And when we're looking at the overall sectors that are in the spotlight, there's pressure on IT, auto, PSU banks, as well as FMCG, while to a certain extent, media and energy are holding out. But let's also hear it out from Ramdev Agarwal, the chairman and co-founder at Motilal Oswal Financial Services, who says that the IT sector has a lot more potential.
IT has had the most dramatic profit pool expansion from 2000. In 2000, it was not even a percentage of the total profit pool. Today, it is more like 15-17% and growing. And there is no year when it has not gained little share. So my sense is IT story is much bigger. You don't have to stick to the current set of those top big companies. They might give you 10-15% index return or something like that. But below that, there will be a lot of companies which will try to come into the big league. So there will be mid-sized companies which will, because the economics still remain great. And then you have the new set of kind of small companies which are coming up, product companies, AI companies. And so there will be specialized services companies which will be coming up, where the cost structure is in India and the clients are all in US and Europe. So I think that business model has huge potential. We have done in last 20 this is a 23, 24 years story of Indian IT. And first $100 billion took about 20 years to get it. And next $100 billion came in just about 8-10 years. The third $100 billion, I'm not talking a small number. Third $100 billion, I believe, is going to come in 4 to 5 years. So that's the nature of expansion. And there, the players who are going to be disproportionately large, I think they'll make it.
Got a class of 21 companies which went public between 2021 and 2022.
Some of them will definitely make it.
You think some of them could make it big?
Sure, because that hype is busted now. There's no more hype. Last year, we were in November, December last year, there was a lot of hype, crazy kind of valuation. And so those things are gone. 60-70% correction has happened now. Can it correct another 23%? That you cannot take it away. But now the promoters have also come to the senses. They also want to make profit. They want to make profit very quickly. And in any case, they want to make large profits. So some of them will be very successful. And some of the companies are very unique. There are no Me Too companies in that particular segment. So I think if there is a profit pool, if the consumer behavior has changed in some of the companies, clearly digital empowered companies are the companies where you can see few 1 lakh crore, 5 lakh crores companies coming in very quickly. If at all it has to happen, it will happen very fast. Otherwise, they'll just fall by the wayside.
All right, that's Ramdev Agarwal sharing his view on the IT sector, and from one veteran to another. And Sunil Singhania, the founder Abacus Asset Manager, says that by 2024, earnings will be led by financial services. Let's listen into his view on the banking sector as a whole.
I think January saw the best results from banks, but even then, year to date, banks have been one of the worst sectors in terms of movement. However, having said that, if you see, what we are heading into, so the retail side of the credit demand is strong, and for a change, you also have now the capex cycle picking up, and you have corporate demand for credit also moving up. Yes, there will be some impact of the liability cost moving up because FD rates have moved up. But I think in India, on a percentage basis, the increase in interest rates has been much more narrower. So in US, from 1% to 4% is like 300% increase. In India, from 6.5% to 7.5% is like 15% increase. And I think to that extent, 50, 75 basis point passing on is not an issue. Credit costs have never been so good. And I think a function of all these make us believe that at least for the next 2-3 years, banks and financial services are poised for a good show as far as earnings is concerned. Now, for banks, earnings have been upgraded. So smaller banks have done well last 1 year, but for the previous 5 years, they have done nothing. And I would say that some of these banks have transformed themselves, in terms of adoption of technology, in terms of moving to better practices, in terms of lending as well as attracting customers. And some of them still look pretty reasonable given their faster growth trajectory. At the same time, I think in banks, one has to be now a little bit more choosy in terms of bank to bank.
Okay, so that's a word coming in from Sunil Singhania as well. But let's go across to Hemant Sikka, President, Farm Equipment Sector at Mahindra & Mahindra. Mr. Sikka, hi, good morning. Thank you so much for making time and speaking with us. First up, I just wanted to start by talking about the recent predictions coming in with respect to the weather and the IMD forecast, wherein they're talking about the El Nino impact going to be there this year. What does this mean at the time when rural recovery was already a tad bit tepid? Are you a lot concerned about it?
So first of all, for the tractor segment, this has been one of the best years so far. The tractor industry is likely to grow upwards of 12%. So far, YTD, the growth is 12.1%. And with only month of March left in this fiscal, we are looking forward to this kind of strong growth to continue in the month of March. So even though rural demand has been tepid for certain segments of the industry, but for tractor industry, this has been our best year ever. Having said that, clearly looking at the way ahead, what indications we are getting is that there is a likely of El Nino coming in the monsoon of this year. However, still this is very early days because more data needs to be processed. IMD has come up with the latest outlook saying that by middle of April, they will have better data to say what kind of El Nino will be there. Whether the El Nino will be weak, moderate, strong, these are the kind of signals that we need to monitor. So right now, there is a higher probability of El Nino happening. But what is the intensity of El Nino? I think that is what we need to monitor. So I would still say these are early days. By middle of April, we'll have a better idea.
Isn't there a dichotomy there? Rural demand under pressure, agrarian economy is doing okay. Tractor sales is doing okay because agrarian economy is doing okay. If agrarian economy is doing okay, why is there a crunch in rural demand?
So Nikunj, this has been a topic of discussion throughout the year, that how is it that tractor industry is doing so well when other parts of the rural economy are still looking sluggish. I think there are 3-4 factors which are aiding the demand for tractors. One is that we have had 4 back-to-back years of normal monsoon. This has never happened since the time records are kept since independence of the country. So this has been a very major factor. The water reservoir levels are upwards of the 10 years average. As a result, we have seen that the sowing and the resultant crop production has been hitting record after record in the last 3 years. On the other side, the output prices for wheat, mustard, oil seeds, pulses, they are all holding very well. So as a result, what's happening is that the farmer's cash has improved over the last 3 years, what we have seen. So what happens in a rural economy, now farmers have choices, whether he wants to spend this money on discretionary or whether he wants to spend the money on creating an asset. Generally, what we have seen is that for a farmer, whenever he is able to have cash in his hands, he would go and buy the tractor because he's creating an asset. He's creating an earning member in the family. And I think that has helped the tractor industry to grow so well. I mean, this year we are looking at an industry which is a 12% growth. You would recollect that last time when I came on our channel, we were giving a guidance of 5 to 6% for the industry growth. Now it's upwards of 10% growth. So clearly the demand is very strong. And this is clearly on the back of good monsoon, good crop prices, very good sowing, good crop production, and the farmer's inherent bias for putting their extra cash into creating an asset.
Let me ask you something which Anisha also referred to, the impact of El Nino and strong monsoon. Markets tend to think that poor monsoon means poor crop, it means poor sales for tractors. But do you think that's history now? Because that time the land and irrigation was different, water levels were different, water reservoir levels were different, and God forbid, even if we have a deficient monsoon this year, the effect will not be felt this year, it will be felt next year or the year after.
Nikunj, this is a very important point what you brought up, and I completely align with you. Even if we are able to pass this year with, let's say, a moderate kind of El Nino, I don't think this will have a very severe impact on the crop production for the reasons outlined by you. The reservoir levels are running very high, and we have seen in the past data also that whenever we have been hit by El Nino, if the water reservoir levels were good, we were able to pass that particular year with flying colors. It is only if we lose next monsoon again, then the real stress happens. So I would completely agree with you that if we get a reasonable kind of monsoon this year, even if it is not like excess of normal, I think we will have a very good crop production again this year.
Mr. Sikka, hi there, morning. I just wanted to understand what the situation is when it comes to exports as well. Is there any sort of a slowdown that you're experiencing? Because across the industry, there has been pressure on exports.
So for us, exports has actually done very well, because even with all the global headwinds that you are witnessing, we are still up by 5% this year. And let me say that this 5% growth for us is on a very high base, because last year our exports business grew 65%. So on a very rapid high growth of 65% last year, this year again we have grown by 5% so far, YTD this year. But clearly, I would agree with you that there are pockets in the global economy which are witnessing stress. For us, Brazil, Mexico, US are doing very well. Africa has done very well for us. However, countries of South Asia are slow. Nepal, Bangladesh, Sri Lanka have been slow for this year. So overall, I would say this has been a challenging year, but I think overall we have held up well with a growth of 5% in our exports this year.
Sure. Mr. Sikka, also wanted to get a sense from you that the new TREM 4 norms are likely to be implemented in calendar year 25. It's still a while away. But ahead of that, what kind of impact do you see on demand, and what about pricing? Are you taking price hikes, or are you passing on the benefits of lower commodity now?
So from 1st of January this year, the TREM 4 norms have been implemented for tractors which are upwards of 50 HP. But let me just share more data point with you that India, the largest block of tractor industry is within 30 HP to 50 HP. This is 83% of the industry actually falls between 30 HP and 50 HP, for which there has been no change in emission norms. The emission norms to TREM 4 has happened only for tractors which are over 50 HP and above, which is only 6.5 to 7% of the industry, which has already implemented, and we have not seen any impact. The pricing has got established in the last 2 months. The new tractors will start going in, because unlike the auto industry, where the government didn't allow them to sell even a single vehicles after a day, for tractor industry, whatever production has been done till 31st of December, we have 6 more months to sell. So right now the industry is still liquidating their old stocks. New stocks have gone into the market. The prices are getting established. So I'm very happy to share with you actually on the behalf of industry that the way, with close cooperation between TMA, which is the Tractors and Mechanization Association, which is the all tractors players coming together, and the government of India, I think broadly we have collaborated very well, and this whole migration to TREM 4 for 50 HP and above has actually went on very well. Now you have asked for the next level of emission change, which are still a couple of years ahead. Here again, the TMA is in active discussion with the Ministry of Agriculture and Ministry of Road and Highway. And we are very hopeful that with the kind of discussions that we are having, and with the delay what happened with TREM 4, the TREM 5 stage, there will be further extension given to the industry for this.
So tractor sales are doing well, exports are doing well, monsoon will not have an effect. It was, this is like a boom time for the tractor industry. So there is no bad news. There has to be some bad.
I lost the audio. Can you just repeat the last line?
I'm saying tractor sales are doing well, margins are decent, exports are looking up, monsoon impact will not be there, emission norms are not a challenge. So there is no bad news at all. I mean, what is the bad news? You have to tell us that what could challenge this scenario.
I would, Nikunj, keep a very close watch on the second last factor that you said, which is on monsoon. as we discussed in the earlier part of this discussion, that there is a likelihood of a El Nino happening in India after 4 strong monsoons back to back. Right now, the probability is at around 49%. Let's see how the probability moves. I would keep my fingers crossed till middle of April, by which time we will have better data coming in. And clearly keep a watch on what's happening on the intensity of El Nino. If it is a weak El Nino, moderate El Nino, as you rightly said, I think we'll pass through with reasonable monsoon this year. But if it is a strong and very strong monsoon, obviously then the monsoon will get impacted. And generally what we have seen from the past data, that if you have a very strong impact on monsoon, the agri production goes down by 2 to 3%. Now, in the last couple of years, we all know that agri production has been hitting record high. So what is the impact of 2 to 3% loss of agri production, which will happen? Suppose it happens, if there is a very strong El Nino, how it will impact demand? Now, these are factors that we have to watch more. We are very, keeping a very close watch on what's happening on the ground, regularly in touch with the key stakeholders across the agri chain. And I think by middle of April, end of April, we'll have a very good idea of how the year will pan out for us.
Appreciate your time. Thank you so much for joining in and giving us a clearer picture for the on-ground situation, tractor sales, and what the outlook is down the line. On that note, then, we take a very quick break. Be right back with more on the other side.
Welcome back. Well, the recovery that we saw yesterday was definitely short-lived. At least that's what it's looking like at the moment, because the Nifty has slipped below the mark of 17,400. 17,362 is where we're at, very close to the lowest point of the trading session. It's IT which is really taking the maximum amount of beating. So TCS is down a good 2%. Infosys is the other heavyweight, which is down 1.5%. And Axis Bank, with the news flow of the integration being out of the picture now, is also seeing a cut of around 1.4%, because there is the worry that the benefits of the synergies will only start coming in from FY26, and that's a little too late as per some of the experts as well. Adani group of companies definitely deserve mention. Look at the intraday recovery on Adani Enterprises. At the start of the session, it opened with a cash down of 10%, and now it actually moved into the green, and now just around that flat line is where Adani Enterprises is. Heavy volumes also seen on Questcom. It's already 5-6 times the 10-day average, and the stock is sitting high around 6%. We have been flagging out RVNL, 10% higher on that one, and KNR Construction too is sitting with a gain of 2%. Also, let's quickly pull up Electra Green Tech, that stock, and let's pull up maybe a 1 month chart of the stock of how that has been performing, because if I have it right, last week itself it had seen a surge of around 20%. Today it's higher by around 6% as well. So that stock has definitely been doing well, 12% higher as far as 1 month picture is concerned. But some of these mid-cap companies have been doing well, but the retail interest from the market seems to be waning. In fact, we'll discuss that more with our experts. But first, let's go across to my colleague Sharad to understand of how the retail participation has been panning out in the equities over the last few months. Sharad, take it away.
Well, yes, there are major factors actually spooking the market and hurting the retail sentiments, and of course in a short-term basis there's an absence of major macroeconomic trigger, and apart from this, even there is a lower trading volumes coming in, and because of that the liquidity numbers are also being impacted in the trading space as well. Of course, the FPI fallout is also happening over here, where the numbers are actually coming down over the last 2 months itself, in the month of January and February. Apart from this, Adani Group rout was also there, which actually impacted the market sentiments as well. Now, speaking of that, inflation has actually not fully peaked out yet, and a lot of money, FI flow, is actually going to China and Taiwan, especially on the reopening theme as well, and the valuations are still remaining pricey as compared to the emerging markets. But let's look into the data. On the long-term basis, the SIP levels are still pretty at a strong levels, at the record high levels of almost 14,000 crore rupees for the month of January. But the interest in the retail, as we have pointed out, that has dipped, and if you see the NSE active users, that numbers have come down and it's below the 35 million mark. And do remember, the retail turnovers numbers are also coming down. Now, what is the case over here? Staying investment in the long term for Indian markets, and of course we have taken 3 asset classes. We'll talk about investing in gold. For MCX Gold itself, you see the numbers over here on a 15-year basis, it has given a 118% return. Now, from gold, we move to the Nifty index. Now, had you invested over here, between 10 to 15%, your returns would have doubled, and that would have been as high as 230% on a 50-year basis. Now, deposit rates also, the movements have happened, and over here itself, we see the returns were gyrating between 6.5 to 10%. on a long-term basis between 5 to 15 years. So this is your case for a long-term investment. But is the outperformance of the Indian market over? That is something which you need to ponder upon. Over here we see on a 3-month basis itself, Nifty has fallen almost 7%, while its peers have actually come up on a positive note as well. Now let's look at the mutual fund space. That is also very interesting. If you stay invested in the mutual fund space, what returns you can expect? And this is the 10-year returns which we have taken, and of course these numbers are on a compounded annual basis. And over here, small cap and the mid caps yielded roughly 19 to 17%, while you invested in a thematic mutual fund scheme like IT would have given you an 18% return.
Thanks very much, Sharad, for giving us all of those details. Well, let's get a move on then and talk a little bit about the outlook on retail participation in equities, largely owing to the massive volatility that we've seen. Has there been a drop in retail participation, and is that keeping investors at bay? We've got Prakash Gagdani, who's the CEO at 5paisa.com, as well as Amisha Vora, chairperson and MD at Prabhudas Leeladhar. Thank you so much for taking time out and joining in. I just want to understand, Prakash, are you seeing, owing to the kind of drop that we've witnessed, owing to the acute volatility, has there been an impact in terms of the retail investor participation?
Hi, very good morning. First of all, thank you for having me on your show. As you rightly said, the retail participation has been muted, and not just for a while. If you look at the entire 2022 full calendar year and now, the retail participation overall has been dipping a bit. And that's largely, if you compare that with the kind of the Nifty, which went up, or all the indices, be it mid cap, small cap, large cap, went up in 20 and 21. Retail participated in full flow, demat account spiked, participation spiked. But after that, now for the entire last 12 to 14 months, markets are sideways. And we all know that retail normally participates in mid cap, small ticket size kind of investment. And that is where, because of lackluster return, retail participation on actively, which is on the secondary market, is muted and is going down. And that's visible from the retail turnover that you see on the NSE, which last year from almost 35,000 crore, now we are at 20,000 crore on a daily basis. So that's definitely down. And in comparison, what has happened is that the other traditional asset classes like gold has given very good returns because of interest rate rising. The FD rates, which used to be around 3.5-4%, is now some banks giving almost 7.5%. So when you get these kind of returns in other assets vis-a-vis lackluster performance in equity, obviously the retail will shift, and that's the result. We see a muted performance by retail in the cash market.
Misha, good morning. So nice to have you back on ET Now. Is there a drop in retail interest? Is there a drop in retail activity? Do you think retail investors are now asking a very basic question that why are we in the market? Because the days of lockdown when we were sitting and trading and making money, that's over?
Yeah, Anuj, I think we have to look at this entire thing in last 3-year parlance. If you look at most of the demat the demat holders, the retail investors have come in last 3 years from the start of pandemic. We almost at from 3.5 crore demat account, now we are at 11 crore demat account. So practically you can say that most of the people came in the start of pandemic, where for the first year the Nifty gave 150% return. So most of the people thought that there is no asset class better than equity which can give 100% return every year. But that is, people who are seasoned in the markets, who have spent 10, 15, 20 years, know that it's a cyclical market, and sometimes it goes and gives phenomenal returns, and then there are lackluster period for almost 2 to 3, 4 years. So that's something which has not happened for a majority of customers.
Okay, that question was for Amisha. I know, Amisha, you must be thinking that if you have started the show with you. Ladies first always. So how you been, Amisha? Long time.
I'm very good. And Nikunj, one important thing to keep in mind is that particularly during those COVID times, most of us were confined to homes. And if you see it on a very larger map, the working capital used in the businesses or any other modes were all released. So there was ample time and there was ample money. And the only activity which was on was markets. So it saw a gush of new investors coming in. I think out of that, those who really went for mutual fund, then the SIP thing is continuing. But those who started trading on their own have not only found last 1 year very sideways markets, but also that their own businesses are needing money as the actual economy is doing better. And apart from that, time at their hand is very limited. I always say that, in retail, there are discount brokers and there are advisory-led brokers. So the brokerage and discount brokers is really low, but the time consumed, if you add to that, is really high. So I think a combination of factors is at play, and particularly time and money available only for markets has reduced.
Amisha, so are you calling this the new normal? Is this the normalized trend that we should expect going forward?
If you're asking me, I would say that no. This is also combined with a fact that FI flow has been consistently negative. So when we will see a time when after a little consolidation in markets that we don't look too costly or little overpriced as compared to the growth prospects and also as compared to the competitive other markets, I feel that with their flow starting, the overall activity also will start, because market always need, and particularly retail always needs, a leader, and that they try to follow in terms of volume. And one of the other reasons also can be, and it is, that a safe fixed income return now is much higher than what we were seeing during those COVID days. So a fixed income, when gives such high returns, the risk adjusted equity returns really takes a knock, and which is also one of the key reasons.
Okay, Amisha, that point is taken. The reason of why, there has been a shift from equities to the rest of the asset classes as well. But going forward, what do you think will be the key triggers for the markets to kind of see a bit of a pullback? It'll be remiss of me if I don't ask you on the markets at the moment as well. When do you see the participation coming back and a bit of enthusiasm, because it's been fairly lackluster with lack of participation?
So I think markets will take a little while. We were looking at a very range-bound market anyways, because it is juxtaposed with comparatively good economic macros, slightly deteriorating economic micros, and above all, the liquidity is continuously reducing in the system. As RBI continues to try and protect the currency, gradual illiquidity is getting reduced in the system. So in that scenario, to expect a runaway rise in Nifty is difficult, according to me. And as we all know, how we had a hockey stick run in the markets when we just opened up, I think that's really been happening in China and the related markets as they have finally opened up post the pains of last 1.5 years. So a lot of attention and investments is going there. So it will take a time while before we break this very range-bound markets.
It's going to take a bit of a while before we break out of the range as well. But Prakash, wanted your sense, if you can help us with some more data in terms of which segments are seeing the maximum amount of weakness. Is it that the participation of retail is lower in F&O, or even in terms of cash market, you're seeing that the volumes are on the lower side as far as retail participation is concerned?
See, what has happened is that broadly the participation in the cash segment has reduced. One is obviously the markets and the kind of performance. Second is the leverage part, which was broadly there up till late 2020, had, because of the regulatory change, went out. So now it is a standard leverage that is allowed in the cash segment. So a lot of traders who are trading intraday in cash segment turn towards derivative segment, and that's why you see a very good participation in derivative segment, whereas the turnovers have almost gone up by 2 to 3 times. So a good section of traders have moved. So that was one impact on the cash market and a positive impact on the derivative market. So overall, if you look at cash market is the one which is being beaten down, and the turnovers we have seen almost half in last 12 months.
So turnovers have halved as far as the cash market participation of the retail segment is concerned. But Amisha as well as Prakash, appreciate you joining us on ET Now today. Thank you so much for making time. But shifting focus and talking about what's happening in PVR, because that one has unveiled its shiny new 11-screen multiplex in Lucknow's Lulu Mall, expanding its operations across 158 screens in Uttar Pradesh. In a conversation with my colleague Sumita, PVR CMD Ajay Bijli says that synergies from the IEX deal will be to the tune of around 225 crore rupees over the course of next 12 to 18 months.
Movie going is very, very normal for people in India. That's why I love the Indian market, and where there's a huge quantity of films that come, as well as there is a huge consumption that happens. So I think, but you have to make it more and more experiential.
Right.
Because obviously otherwise people can sit at home and, or any device they can watch movies. So if they come out of their homes, which is a big deal, but they're already going to the shopping malls, they're already eating, they're already shopping. And so therefore the format that we create has to be experiential, where they say, wow, this I can't get at home. So which is the reason why we are trying various formats, the big screen, sound, projection system, Dolby Atmos, 4K projectors, laser projectors.
Right. So now let's talk about the brass tacks. Your deal with the IEX is almost finalized, but where do you presently stand on it? How many more days or weeks to go before that happens?
I think it's all done now. I think we got all the approvals. It's done actually, to be honest with you. There's very little formalities left now, but the merger is complete. We've got all the approvals in place.
Okay.
I think the incorporation, the new brand, the new company name, PVR IEX, all that is in the process. So another 4-5 days, maybe a week, it will all be done.
Right. So from the branding aspect of it, what are you going to do with, for example, this Superplex? Will the branding be changed to PVR IEX, or will it just have PVR, or are you going to change the branding for the multiplexes that will come post this?
There are already 1,700 screens which are already in existence of the two brands. I don't think we'll be spending capital on rebranding, because 100 million people have been coming to PVR every year, 70-80 million people have been coming to IEX every year, pre-pandemic. Our brand has been in existence for 25 years, PVR has been in existence, IEX has been in existence. There's already a brand equity that is built. So therefore, these properties will remain the way they are. Going forward, we'll take a view how to brand the coming properties.
Right. So now that we're talking about the merger, it's the biggest in the country. Everybody's been talking about it, and how this will sort of change the fortunes of the multiplex culture, the multiplex industry. But if you could take us through the size of it all, how big is it going to be? What are your plans? What is your guidance, if I may talk about that? How many more theatres do you plan to sort of open? If you could talk about that a bit.
Well, one side of our business is joint at the hip with the film industry, and one side of our business is joint at the hip with the retail industry and the shopping center and mall development. There are some incredible mall developers like DLF, Phoenix, Prestige, Unity, Lulu, where we're sitting here. They've all announced plans to make more malls. So you'll be surprised to know we have almost 200 screens that are fit out just now in different parts of the country. But I don't normally give a guidance, but roughly anything between 100 to 150 odd screens is what we'll be opening every year.
So how much capex is expected to be?
Well, each screen costs roughly about 3 crores. So if you say 150, about 450 to 500 crores of capex is going to be spent.
And what synergy benefits can be expected from this merger? And is there a way to sort of quantify them?
I mean, I just finished a Kotak presentation in Bombay with all the investors. I wasn't expecting you to ask me the same questions, but you are. We've given a guidance of anything between 225 crores synergy in the next 12 to 18 months.
And what about the ticket prices? The ticket prices did go up a bit in the past couple of months. Are they going to, after this synergy, are they going to come down, or is there any scope of increasing them further?
I'm glad you used the word a bit, because from 2019 to 2023, actually our prices have increased less than inflation. So because people look at only some luxury formats or premium formats and they think that is a ticket price, but our average ticket price is nothing more than 230 rupees at the moment for the entire circuit.
What about the average occupancy levels?
We don't measure by occupancy. We look at the number of people who should be coming.
Okay.
But if you look at the South circuit, that has gone up to the pandemic level, pre-pandemic level. North, West and East, it's taking its time to pick up. That's about 60 to 70% recovery just now.
All right, that's Ajay Biji exclusively speaking about the merger synergies, the outlook in terms of OTT, as well as what the plans are for PVR down the line. As we speak, that stock currently at about 15.49. Time for a very quick break. Stay with us. Lots more corporate voices and market talk lined up.